In this article, we look at the impact of today's interest rate and monetary policy environment on central banks' own balance sheets and how we manage any of the risks arising from that to ensure that central banks can retain the financial independence that is so vital to them fulfilling their mandate. So if we think of central bank balance sheets in normal times, they're usually fairly straightforward. On the liability side, for example, there would primarily be two entries, which would be banknotes or currency in circulation, and also deposits from credit institutions with the central bank, usually in the form of minimum reserves. On the asset side, there would also be primarily two main entries, which would be monetary policy operations, which in normal times would take the form of short-term provision of liquidity to credit institutions, and then central banks' own investment assets. Since the onset of the financial crisis, however, monetary policy can no longer be considered to be operating in normal times. Indeed, in recent years, the ECB has introduced a number of non-standard measures in order to support the economy post-crisis. These have included historically low interest rates, extended provision of liquidity, and indeed purchases of bonds under a range of asset purchase programs. Collectively, these non-standard measures have increased the size and magnitude of central bank balance sheets and the risks held therein. These changes to central bank balance sheets, largely as a result of non-standard monetary policy measures, have led to an increase in the range of financial risk exposures on central bank balance sheets, in particular interest rate mismatch risk. This arises largely from the fact that many of the bonds purchased by central banks under the asset purchase programs are fixed at low and often negative interest rates. However, as economic conditions improve and inflation nears its target level, we expect the path of interest rates to increase. This means that central banks may experience a widening between the fixed, low and sometimes negative rates it receives on the assets that it holds versus the variable interest rate on its liabilities, which is linked to the ECB policy rates, which are expected to increase over time. Within the central bank, as part of our ongoing monitoring of our own balance sheet risks, analysis was carried out to look at the type of risks on our own balance sheet. Following an evaluation of these risks, looking at the likelihood of their occurrence, the central bank prudently decided to set aside a provision of 165 million in the 2016 annual accounts to mitigate against interest rate mismatch risk. In terms of impact, it is worth noting that should these interest rate losses be realised, it will be due to an interest rate hiking cycle in a scenario where the non-standard monetary policy measures that have been implemented have been successful, and we would expect economic conditions to improve alongside that. Nonetheless, provisioning for these losses at this time, when the central bank has made sufficient profits to allow it to do so, will help the central bank to adequately deal with these losses later when they do occur, thereby helping to retain the central bank's independence through robust capital and reserves. And of course, independence is central to our mandate of supporting financial stability and protecting consumers. Should these losses fail to be realised, the provision will be released and written back to future profit and loss statements of the central bank, from which surplus income is distributed to the government.